Hello guys, so you're welcome. This video is going to be this is like the first video proper for this series, right? For the course series, and I'm going to be talking about market structure, like market structure. How is the market structured? Okay, so you're welcome to our first video for the course, and I'll just hop onto my chart and no, not the charts, but I'm just gonna start. Let's just start. Okay, all right. So this is an introduction to market structure. Now, for most of you who started trading, like you could be on YouTube and someone just comes up with an ad and XNS or FBS or something, one of those brokers are telling you, oh, this is how you deposit $10 and then you're going to make $5 million, which is very possible, but not very easy. All right. So most of you, you've already been exposed to the markets. You've seen the charts before. You've seen the charts before. You know what it looks like, and even if you don't understand what it is or what's going on, you have an idea of what is happening. All right. So I'm just gonna, address that in this video, and I'll be doing that by explaining the three market phases. So market structure is just basically the phases of the market, how the market is structured, and it only has three ways. The market can only do three things. One, it's either gonna go up or it's gonna come down. I'm going to tell you about the third one, but let me talk about these ones first. So when the market goes up like this, boop, we say the market is bullish, right? Let me just cross check this. I hope this is okay. We say the market is bullish, and when the market comes down like this, boop, we say the market is bearish. Wait, I'm supposed to, okay. So the market is bearish, right? But the market never goes up like this. It never just pushes up like this. So what the market does is it starts from a low, right? It goes up, creates a high, it comes down, creates another low, but this low is now lower than the previous low, so it's called a higher low. Sorry, this low is higher than the previous low, so it's called a higher low. And then it goes up, pushes above this initial high, creates another high that is higher than the previous high, so it's called a higher high. So when the market is going up, it just creates a series of higher lows and higher highs and higher lows and higher highs and higher lows and higher highs and higher lows and higher highs, right? Pardon me. So as far as the market keeps doing creating higher lows and higher highs, you see it's an upward market, right? It's trending upwards, right? And that's also called a bullish market. Why is it called a bullish market? I'm going to tell you, but for now, this is all we have. A market that goes up, that trends upward, always creates higher highs and higher lows and higher highs and higher lows. And what you want to do in this market condition is you want to take what we call buys. And what buys basically mean is I'm saying the market is going to go up, so I'm putting my money where my word is. So I'm going to be taking buys here. So if you take a buy here and the market goes up, you're going to make money, right? And it's a general rule to always buy at the lows and sell at the highs. So since we are seeing higher lows, we want to take buy positions at the lows. All right, so we can buy here, we can buy here, we can buy here, we can buy here, and so far as the market keeps going up, we keep making money, right? Until you're satisfied and you want to close out. All right, so that's what happens in a bullish market. Whereas in a bearish market or a downtrending market, right, the market does this. It creates, what's this now? Let me use, okay. So in a bearish market, what happens is the market starts from a high, creates a low, creates a high, another high lower than the previous high. So we call this a lower high, and creates another low lower than the previous low, call this a lower low. So it keeps creating lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. All right. So this is what a bearish market does, right? And this is the fundamental structure of the market. The market cannot do anything more than this. So if you already know how to spot this on the market, on the charts, I mean, you're already like on your way to being profitable. It's actually very simple, all right? But it's not this simplistic on the charts anyways, and I'm going to show you. And what you want to do when the market is trending downward is take sells, right? Sells here, sells, and you always want sell at the top. So you sell here, sell here, sell here, sell here. We also call sells short. So you're shorting the market right? On this other, on the other hand, bullish on the other hand, a bullish market on the other hand, you are taking long positions. So long is for an upward trending market, while sells or shorts are for bearish or downtrending markets. All right. So why are they called bullish and bearish market conditions? Why the word bulls and bears? So a bull is an animal. A bear is also an animal, but a bull is an animal that attacks with its horns. So it's going to attack upward, right? So you just go online and look for videos of bulls attacking people. You see they, swing their head downward and then attack upwards, right? Because they attack with their horns. Because they don't have claws, they have hoofs, so they don't have claws, so they have to attack with their horns. While bears, on the other hand, attack with their claws. Okay, they attack with their teeth as well, but like mostly attack with their claws, and then they have to attack downward. So if you see bear videos where bears are fighting, they always attack with their claws mostly, and then bite you to finish you up. I mean, if I'm fighting with you, I have to bite you at some point. Oh boy. All right, so the next market condition is what we call, so the market is not going up, it's not coming down, right? At least not in the same sense as the bullish and the bearish market. And this is called a ranging market or a consolidating market, right? Let me delete, should I delete this? I'm just going to put it on top. Okay, so in a consolidating market, what the market does is it still moves, like it still creates highs and lows, but it looks for a fixed high and a fixed low, and then just cause it does not have stress, it does not have strength to just stress, it just plays inside. It just keeps bouncing along the container. So it's like a container, it's like a channel. It just keeps bouncing up and down and up and down until it eventually has the strength to break below. Yeah, so let's say it eventually has the strength to break below or break above and continue whatever trend it's on, right? So trading the consolidating market is tricky even for pro traders. So generally it's not so tricky for pro traders anyways, but generally what you want to do in the consolidating market is to not trade, just stay out, right? Don't even bother, especially when, because most times you don't even know what the market is doing. All right, so it takes a certain level of skill and understanding to be able to trade a consolidating market, but it depends on how big the range is. It depends on how the distance between this point and this point is. You can always make money, because as you can see, if you know the market is going to bounce off this top and come down, you can actually just take a sell here, short the market to this point, close your short position, take a bullish, take a buy, close your buys, take a sell. So you can just keep doing that and you're going to keep making money until the market eventually breaks out, right? But now, since the market, we don't know what the market is doing at, we can never predict what the market is doing. What we are just doing is analyzing and taking the best probability shots at the market. Okay, so the market was the trading industry, the whole trading platforms we use was structured in a way that you can at least reduce how much you're risking. Okay, so when you take a buy position from this bottom, you can tell the market or your trading platform or your broker rather, that I don't know what this market is going to do, but I'm betting it's going to go up. Okay, so when it goes up to a certain point, just because I might not be around or I might not fully be in control at the time, maybe I'm asleep or maybe the market is moving so fast, when it gets to this certain point, just because this is the point I'm comfortable with, close my trade and send my profits to my account, right? And we'll call that a take profit order. All right, while at the same time you tell the market, I'm not sure what the market is going to do, I'm just mostly positive it's going to go up, but just in case it comes down and it comes down below this point, close the trade and minimize my losses so I don't just keep bleeding money out of my account. And this is called a stop loss order. And these are orders as well, because in the market two things are always happening: you're either buying or selling. If we are not buying or selling, we are talking about whether I'm going to buy or not, right? So if you show me, if I go to a conventional market and I'm talking to a vendor and we spend 5 hours talking, I didn't go to the market to gist, I didn't go to the market to make find a new friend. I actually went there to buy something. So the conversations I'm going to be having mostly is going to be centered around price. Even if you're discussing the quality of the product and where you sourced your products from, in my head, I'm going to be trying to relate this to how much is this now going to cost me. So if you tell me this bag is a Gucci bag, an original Gucci bag, in my head I'm thinking, like already I know Gucci bags are supposed to be expensive, right? But if you tell me it's a Gucci bag that was made in Nigeria, I'm not thinking like, is this supposed to be as expensive as this guy is saying, because like they don't make Gucci bags in Nigeria. I mean, they make it in the USA, and there's also like a USA in Nigeria, for those who know what I mean. All right. So that's that. So you always like have to put in your take profit and your stop loss. So what this means is, if I take a buy, for instance, me buying means I'm buying from someone who's selling, right? So my buy position is someone's sell position, right? And then I'm feeling that person sell by buying from the person. Okay, while if someone, sorry, so when I buy all the way to the top and I'm taking profit, I'm closing that order, what I'm doing is I'm selling that position to someone else. So every buy that is taken in the market and then it reaches take profit, or the trade is closed in profit, you're selling to someone else, right? Selling at that price to someone else. So when you close your trade now, that buy position automatically turns into a sell position. Not for you, because it's not entering your, like it's not coming from your account, but to someone who is actually going to buy from you. Like it happens, but it happens automatically, and the market is so big that it absorbs all of these orders, you know, without you even knowing. But it's, the market always leaves traces. It's like you always be able to see it on the charts, right? And I'm going to, as you progress, you're going to know what's going on. And the principle of profit making is getting something cheap and selling it when the price is high, right? And where I'm going to make my profit is from the difference. So if I buy something for $5 and I'm selling it for $50, my profit is actually 50 minus 5, which is $45. So that's the difference, and that's my profit. Okay, so because the profit or loss is always from the difference, you don't want to be having negative difference, as in you don't want to buy something for $50 and sell it for $5. That's negative difference, and that's going to be loss for you. Okay, so that's why whenever price is really high, you sell at the top, because you don't want price to come down before you're closing your order, right? So you want to sell, like you're basically selling and offloading that position to someone who's going to buy at a lower position. This is all going to make sense later on, right? For now, this is the basis of market structure, and if you can spot this in the market, you're good to go. Okay, so I'm just going to show you what this looks like on the charts. All right, and as you can see, is not as simple as it looks. I mean, if you've trained your eyes long enough, you'll be able to see. So already you can tell this is a high, this is a low, this is another high, lower than the previous high, formed a low, lower than the previous low. So it's lower highs and lower lows, and this is what's the characteristic of a bearish market. So what you want to do in this condition is take sales, just sell. Whenever the market creates a new high, sell, target the previous high. Ideally, your stop loss is supposed to be above the previous high, because if this structure is to be maintained, price is not going to come up here. So let me say this is my previous high, this one here. So price is never going to break this if this structure is maintained. Okay, and then you wait until the market creates another high, take another order here, stop loss here, targets, you know, just keep doing that. You're going to keep making money through and through and through and through. It's actually that's why Forex is very simple, but it's not easy, because it's not even about what you know, it's about who you are, right? So it's a psychological thing. All right, so the market is gonna keep making money, breaking down, like making lower lows and lower highs and lower lows and lower highs in the bearish market. All right, whereas in a bullish market you have this low, high, higher low, higher 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 high. So this is a bullish market, right? And all you want to do is take buys. So if you kept buying from this bottom, buy here, stop loss below the previous below the previous low, take another buy here, for instance, stop loss below the previous low, targets the high, you're going to keep making money. Always. It never changes. The market never changes. That's why it's very easy to trade the Forex market, but very hard. It's very hard because nothing good comes easy, right? You have to learn and unlearn certain things you knew about how money is being made, and then mostly master your emotions. That's why most people struggle. Okay, so a consolidating market, which is a market that is stuck in between a range, is going to look like this. This doesn't really do it for us, but I'm gonna use let me look for something else. Let me look for, this is Bitcoin. Bitcoin is quite it's just the way it is. It's really volatile and all. Let me see this pair. What's this? This is gonna be a huge loss. Okay, I'm just trying to find bearish, sorry, consolidating market. Well, I'm actually seeing them, but it's not, it's not. I'm looking for an ideal consolidating market, and I can't find it because there's no ideal in real life, but we'll be able to find something we can use. So here, found one. Boom, 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 boom. All right, so the market created a high, a ceiling, and created a low, and just bounced in between. Just kept bouncing in between. It started from this low, went to this high, low, high, low, high, low. You see, it created a high, but just because it had not touched this top, it didn't come back down to this low. It came close, but eventually went up, created a high, and then broke down. Okay. So this is what the consolidating market looks like. So you can always buy from the top and sell at the bottom if you want. It's your money. You're gonna lose it if you lose it, but you're gonna make money if you make money. All right. So these are the two market phases, and that'll be all for this video. On the next video, I'm going to be talking about candlesticks, because when you look at the chart, you see certain things, and those are called candles or candlesticks, and you want to understand them to be able to trade the Forex market. Okay, so that's that.